Hello and welcome to the video on the benefits of using accounting ratios. Number 1. Quick analysis. The ratios condense detailed financial statements into understandable figures, and they help reveal relationships between accounts, making financial data easier to interpret. For example, with our friend Blue and their bakery, they might work out that the current ratio is 2-1, and this means that they have £2 of assets for every £1 of liability, and this gives a quick summary that the business is in a healthy position. Number 2 is that the ratios help assess the financial health. The ratios help provide insights into areas such as profitability, so is the business generating enough returns? Liquidity, such as can the business pay short-term obligations? Efficiency, such as how well are the resources being used? And also solvency, is it stable in the long term? For our friend Blue and their bakery, they may calculate a debt to equity ratio of 0.5, and this shows that the bakery is not heavily reliant on debt and is a sign of financial stability and health. Number 3 is performance tracking. The ratios show trends over time which help highlight any strengths or weaknesses and enable early detection of issues such as declining profit or cash flow problems. For example, with our friend Blue and their bakery, the ratios may allow them to compare gross profit margin. For last year, they had 40%, and this year it went to 50%. This shows an improvement, which could mean that there is a better control on costs and also higher profitability. Number 4 is comparison and benchmarking. The ratios allow you to compare performance with past results or industry standards and could help identify areas for improvements. For example, with our friend Blue and their bakery, if other bakeries have a higher net profit margin of on average 20%, but Blue only has a 5% margin, Blue knows that there's room to improve, either through pricing or reducing costs. Number 5 is decision support. The ratios can help owners, investors, and managers make informed choices by answering questions such as, is the business profitable? Can it pay its bills on time? Or is it using resources efficiently? For example, with our friend Blue and their bakery, if they check inventory turnover and they find out that theirs is lower than industry average, then Blue might have to run promotions to clear stock faster. And number 6 is forecasting and planning. The ratios will help analyse historical data to guide budgeting and strategic decisions, while also supporting resource allocation and risk management. For example, with our friend Blue and their bakery, they could use the receivables turnover ratio to plan cash flow. This would give an idea of how quickly customers pay Blue's business, allowing Blue to plan ahead for expansion confidently by knowing how long it takes for cash to come back into the business after making a sale. Thank you for watching. We look forward to seeing you in another video.